Welcome to Global Markets Brief, your source for in-depth financial analysis and market intelligence. Today, we're diving into one of the most consequential economic stories of 2026, the escalating and increasingly complex trade conflict between the United States and China. This isn't just a tariff dispute anymore. It's a full-scale restructuring of the global economic order, and the decisions being made right now in Washington and Beijing will shape supply chains, investment portfolios, and corporate strategies for decades to come. Stay with us. To understand where we are today, we need to step back and look at the broader geopolitical and economic context. The U.S.-China trade relationship has been under strain since 2018, when the first round of tariffs was imposed under the Trump administration's Section 301 investigations. That initial conflict led to a partial truce, the Phase 1 trade deal, but the underlying tensions never went away. Fast forward to 2026, and we're in what analysts are calling Trade War 2.0, a more sophisticated, more institutionalized, and in many ways more dangerous confrontation than the first. Total U.S.-China trade in goods exceeded $600 billion in 2025. The two economies are deeply intertwined across supply chains, financial markets, and technology ecosystems. This is not a relationship that can be easily unwound, and yet, that is precisely what both governments are attempting to do, at least in the most sensitive sectors. The result is a dual-track policy that is simultaneously cooperative and confrontational, and for businesses caught in the middle, navigating this environment has become one of the most challenging strategic imperatives of the decade. Let's start with the cooperative track, because it represents something genuinely new in U.S.-China relations. The most significant structural development is the proposed establishment of a U.S.-China Board of Trade. This government-to-government body is intended to oversee and manage trade in designated non-sensitive products, creating a formal mechanism for future tariff adjustments and dispute resolution. And the next part of the cooperative track is inside, probably continues to avoid the process of doing a challenge for weeks. The goal is to move away from the crisis-style diplomacy that has characterized the relationship for the past several years and toward a more predictable rules-based process. As part of this initiative, the two nations are negotiating reciprocal tariff reductions on approximately $30 billion worth of bilateral trade. China has agreed in principle to include agricultural products in these reductions, and the White House has indicated that Beijing has committed to purchasing $17 billion in U.S. agricultural goods annually through 2028. The U.S. Trade Representative, the USTR, is actively seeking public comment from businesses to identify which product categories should be prioritized for this long-term tariff liberalization. This gives U.S. companies a direct voice in shaping trade policy, a rare and significant opportunity. This institutional approach reflects a recognition on both sides that the bilateral trade relationship is too large and too complex to manage through ad hoc negotiations and tariff threats. A more structured framework for managing this relationship, even if imperfect, is preferable to the uncertainty of perpetual trade war. Markets have responded cautiously but positively to these developments, with agricultural commodity prices firming on the news of Chinese purchasing commitments. But here's where it gets complicated. While the Board of Trade initiative represents the cooperative track, the enforcement track is simultaneously intensifying, and it's creating significant disruption for U.S. companies with exposure to China. On June 2, 2026, the USTR proposed additional duties of up to 12.5% on imports from China and 59 other economies. These new tariffs followed Section 301 investigations that found widespread failures to enforce prohibitions on goods made with forced labor. This move is part of the administration's America First agenda. With this move as partizes the reshoring of supply chains and leveling the playing field for American workers and manufacturers. The forced labor compliance requirements are particularly challenging for U.S. companies with complex supply chains in China. The Uyghur Forced Labor Prevention Act, known as the UFLPA, creates a rebuttable presumption that goods from Xinjiang are made with forced labor. This has already forced significant supply chain restructuring across industries, from solar panels to cotton apparel. The new Section 301 duties add another layer of compliance burden, requiring companies to document and verify their supply chains with unprecedented rigor. For many multinationals, this means investing heavily in supply chain transparency technology and third-party auditing, costs that ultimately flow through to consumers and shareholders. Now let's talk about Beijing's response, because China has not been passive in the face of U.S. trade pressure. In April 2026, Beijing implemented new regulations on countering improper extraterritorial jurisdiction and industrial and supply chain security. These regulations give Chinese authorities broad powers to penalize companies that comply with U.S. sanctions or export controls in ways that harm Chinese interests. This puts U.S. multinationals in an extraordinarily difficult position, caught between the legal requirements of two governments, but with multiple punishments of capital and colleagues and punishments. In a direct response to the U.S. blacklisting of Chinese technology firms, Beijing placed 10 U.S. industrial suppliers on its own export control list in June 2026. This list includes rare earth miners, MP Materials, and USA Rare Earth, companies that are central to the U.S. government's strategy to reduce dependence on Chinese critical minerals. Beijing also banned 46 U.S. defense and aerospace contractors, including subsidiaries of Boeing and Lockheed Martin, from participating in Chinese government procurement projects. While the immediate financial impact of these bans may be limited for many of the targeted firms, they represent a significant escalation and a direct challenge to U.S. efforts to decouple critical technology and mineral supply chains. The rare earth situation deserves special attention, because it represents one of China's most powerful economic leverage points. China controls approximately 60% of global rare earth mining and 85% of processing capacity. These critical materials are used in everything from electric vehicles to military equipment to consumer electronics. China's ability to restrict exports of rare earths gives it significant leverage in the trade conflict, and its decision to target U.S. rare earth miners directly signals a willingness to use that leverage aggressively. For investors, the implications of this trade conflict are profound and multifaceted. Let's break down the key investment themes. First, supply chain diversification is accelerating. U.S. companies across industries are actively moving manufacturing and sourcing away from China. Vietnam, India, Mexico, and other emerging markets are the primary beneficiaries of this shift, attracting significant foreign direct investment. Investors with exposure to these markets, through ETFs, infrastructure funds, or direct equity positions, stand to benefit from this structural shift. Second, the compliance burden is creating winners and losers within industries. Companies that have invested early in supply chain transparency and diversification are better positioned than those that have delayed. In sectors like solar energy, apparel, and electronics, the UFLPA compliance requirements have already created significant competitive differentiation. Third, the rare earth and critical minerals sector is becoming increasingly strategic. The U.S. government's efforts to build domestic rare earth processing capacity and China's counter-moves to restrict access are creating significant investment opportunities in companies working to develop alternative supply chains. Looking ahead, the trajectory of U.S.-China trade relations will depend on several key variables. The success or failure of the Board of Trade Initiative will be a critical indicator. If the two sides can establish a functioning institutional framework for managing trade in non-sensitive sectors, it could provide a degree of stability that allows businesses to plan with greater confidence. However, the enforcement track shows no signs of slowing down, and the risk of further escalation, particularly in technology and critical minerals, remains high. The 2026 U.S. midterm elections will also be a significant factor. Trade policy has become a politically charged issue, and both parties are competing to demonstrate toughness on China. This political dynamic makes it unlikely that we will see significant de-escalation in the near term, regardless of the economic costs. For businesses and investors, the key takeaway is that the dual-track nature of U.S.-China trade policy means the environment will remain volatile and unpredictable for the foreseeable future. Companies that build resilient, diversified supply chains and maintain strong relationships with both U.S. and Chinese policymakers will be best positioned to thrive in this new era of managed competition. Those that wait passively for the trade environment to stabilize risk being caught off guard by the next escalation. That's our deep dive into U.S.-China Trade War 2.0. The tariffs, the retaliation, and the race to reshape global supply chains. If you found this analysis valuable, please give this video a thumbs up. It helps more investors and business leaders find this content. Subscribe to Global Markets Brief and hit the notification bell so you never miss our daily market analysis. We cover everything from Federal Reserve policy to emerging market dynamics to corporate earnings, all with the depth and vigor that serious investors demand. Thank you for watching, and we'll see you in the next video.